Hi, a very good evening to everyone and thank you very much for attending our webinar. So we will give a few more minutes for more people to join. A very good evening to everyone. I'm Ikai from Fund Supermart, FSM. So welcome to this evening webinar, FSM MAPS, a review of our 4Q 2022 and our strategy for 2023. So 2022 has been a wild ride, to put it very mildly. A combination of many factors have resulted in inflation around the world soaring to new heights. In the fight to bring it down, the Fed and major central banks around the world have hiked interest rates aggressively. And this has impacted growth on a global scale. So against this backdrop, how is the performance of our FSM managed portfolios, or MAPS in short? So with me, I have Colin Low, Assistant Manager of Research and Portfolio Management, iFAST Singapore, who will share with us, the performance of MAPS in the fourth quarter of 2022. Furthermore, he will also elaborate on the outlook for 2023 and the strategies that we will be adopting to face the challenging times ahead. So if you have any questions along the way, feel free to put them into the Q&A box, and our speaker, Colin, will get to them over the course of this evening, but he will mostly answer them after his presentation. So without further ado, let me pass over the mic to Colin to start the webinar going. Colin, please.
Hi everyone, I'm Colin, Assistant Manager of iFAST Research and Portfolio Management Team. It's good to see everyone back here again. So I also help to manage the FSM MAPS portfolio, like my colleague Ikai said. So today I will share on some of the key important stuff on like how the MAPS portfolios have performed in the final quarter of 2022, and more importantly, provide a roadmap for what we are likely to see this year and how we are preparing the portfolios to weather what it is to come. So let me start off with a recap of markets performance last year. As many of you know, the last year was quite a roller coaster ride for markets. There were plenty of ups and plenty of downs, but mostly this roller coaster headed down, unfortunately. And there were several defining moments that shaped returns last year, from Russia-Ukraine war, a stubbornly high inflation that led to the start of the Fed rate hike cycle, as well as a slowdown in global growth. But last but certainly not least, the COVID issue, as well as property sector woes in China. So overall, if you look at performance last year, global equities was down by a drastic 20%, and also global bonds were down by minus 16% as well, both in the USD terms. So that was a bad year, not just for equities, but for fixed income as well. So moving on to a more in-depth breakdown of performance across the regions, you can see that from this chart right here, last quarter's performance can be described as a reversal of the broad year-to-date trend. The losers became the top performers, while the top performers became the losers. And risk appetite in general returned in 4Q last year and carried performance of some of the more cyclical markets. As you can see, markets such as China, markets such as Asia, as well as Europe were up quite wildly as compared to some of the other markets. So this was, and a lot of it was driven by China, because China rallied due to the reopening news and amongst many other positive news as well. So that carried Asian equities along, and both regions became the top performers. However, on a year-to-date basis, these two regions still suffered more than 20% decline. So last quarter was a good ending to what was a bloodbath for both AXJ as well as China equities for last year. If you look at the developed market space, you can see that European equities rallied last quarter as the fear of energy crunch as well as a recession subsided. Japanese equities also bounced higher because of China, because of their intimate relationship with China, and also because of a strong appreciation of the yen. So that drove the performance quite strongly in Singapore dollar terms as well. So now let's take a look at the fixed income markets. And as you can see from this table, across fixed income markets, the riskier segments like the high-yield bonds, as well as emerging market debt rallied. That was helped by the broad risk-on sentiment, as all these most riskier assets were uplifted by the risk-on sentiment. And in particular, if you look at Asia high-yield, you can see that Asia high yield also made strong gains, as China high yield, which is a big component of Asia high yield, jumped after China announced its plan for reopening, as well as various other supportive measures, such as the easing of the 3 rate lines policy, to cite one. And if you look at the more safer space or safer segments, such as your global bonds and your and the more Singapore-centric bonds area, you can find that they generally fared well last quarter. So that is led by a broad decline in treasury yields due to a deceleration in economic growth. And if you look at Asia bonds, Asia IG bonds generally lagged behind because most of the flow that was going into the Asian bond markets went towards the high yield bonds instead of the IG bonds, which are the investment grade bonds. So you can see the clear outperformance between Asia high yield versus Asia IG. Right, so let me now talk about a little bit about our portfolio performance over the past 3 quarters, as well as, over the past 3 months, as well as the 4Q altogether. So given the risk-on sentiment in 4Q with decent performance in both equity and fixed income, as I've shown, our portfolios generally did well. Overall, the growth portfolios returned between 2.3% to 4.5% in the 4th quarter. So this is highlighted by the black bars, as you can see. So that makes it one of the better performing quarters for us. And the strong performance in 4Q was definitely helped by strong portfolio returns in November. As you can see, November, which is indicated by the pink bar, was significantly higher than most of the other months. And that was due to a rally in emerging market equities, which we have a high composition within our portfolio. So while we had losses in December, for most of our portfolios, we still managed to beat the benchmark. So December is denoted, of course, by the gray color bars. So for example, you can see that aggressive growth portfolio was down by about minus 2.5%, while our benchmark fell more than double by about minus 5.4%. So I will show this a little bit later on when I compare our performance against the benchmark. So now let us take a look at the income portfolio. So for similar reasons, our income portfolio did well as well for 4Q. And overall, you can see our income portfolios returned about 2.1% to 4.2% in the 4th quarter. And again, it is shown by the black bars right here. One thing I wish to highlight is that the positive return in November, again the pink bar, for income portfolios might not be as high as growth portfolios. But if you take a look at the negative returns in October as well as December, which are the red and the gray bars, the negative returns were much milder than benchmark. So that shows, or that highlights, the defensive element for our income portfolio, as that is attributed to the portfolio's more defensive fund picks as well as the dividend yielding attributes of the portfolio, and that kind of shielded against the negative performance for those 2 months. All right, so let us move on to the comparison against benchmark across our portfolios. And there are 2 things I would like to talk about when comparing the performance. One is the 4Q performance, and the other is last year's 2022's performance, both of which are highlighted in the both are highlighted in orange in the table right here. So comparing to our benchmark, you can see that in 4Q, the more aggressive growth portfolios from balanced to aggressive all outperform. So only both conservative as well as moderately conservative underperform the benchmark. And that is due to a smaller allocation to equities, which in fact rallied last quarter and outperformed fixed income. However, in terms of our 2022 performance, the more aggressive portfolios are still behind the benchmark, unfortunately, as our portfolios have a higher concentration to emerging market equities, which declined significantly in the first 3 quarters. So while they have rallied in the 4th quarter, the first 3 quarters were still they were still hit quite badly in the first 3 quarters, and the recovery in the fourth quarter is unfortunate. It's unfortunate because it cannot recover from the first 3 quarters of downside. But that said, our conservative portfolio still managed to outperform the benchmark in 2022, which is a good thing for us. So now let's take a look at the performance for the income portfolios. So for similar reasons, the more aggressive income portfolios, mainly the aggressive as well as the moderately aggressive portfolios, outperformed the benchmark in 4Q. In 2022, for the full year, the income portfolio fared better against the benchmark, as compared to the growth portfolios, as the dividend yields, in fact, from dividend yields from our funds help buffer the portfolio performance, while our defensive funds at the same time held up really well. So yes, moderately aggressive as well as aggressive portfolios might have lagged the benchmark, while balanced portfolio delivered a performance in line with that. However, both your conservative as well as the moderately conservative portfolios managed to outperform the benchmark. So now let's take a look at how our fund picks have performed throughout the year as well as the quarter. So firstly, looking at our developed market fund picks. So these are fund picks within the US, Europe, Japan, as well as the internet stocks. So there are two things that stands out here, in fact, when it comes to last year's performance. First, the growth funds were hit hard last year. So if we can take a look at the Lake Mason Clearbridge US Large Cap Growth Fund, for example, as well as the Allianz European Equity Growth Funds, both are hit way harder than our value funds. And then the other one was the O shares or the OGIG ETF was hit hard as well. So those are mostly your growth-oriented funds. But on the other hand, the value-oriented funds such as your JP Morgan US Value Fund, as well as your your HSBC Europe Value Funds, they are more resilient and they held up significantly better throughout the year. And on top of that, if you look at the defensive funds, funds that tilted towards the dividend paying or the dividend funds, in fact, are also more resilient for the past year. So one example is the Allianz European Equity Dividend Fund, and you can see that those two types of funds, the value fund as well as the dividend paying funds, are generally more resilient, and that also helped us to contributed to helping us outperform the benchmark, especially over the last couple of months. And overall, our exposure to value, which we have initiated early on in the year, have helped to anchor the portfolio's performance during this past turbulent 2 or 3 quarters ago. So that also helped a lot. So now let's take a look at the performance of emerging market equity fund. And similarly, you can see for Asia, the more defensive funds such as our Asian dividend funds, in fact, held up better, much better as compared to the benchmark. So a couple of examples are both First State Dividend Advantage Fund as well as the Fidelity Asia Pacific Dividend Fund. So both funds did well, in fact, and outperformed the benchmark. All right, so moving on to our tactical ideas, I guess the key theme of our tactical ideas here, key trend rather, was definitely a tale of two halves for the performance across the year. So while our tech exposure mainly comes from the semicons as well as the Hang Seng tech sector, both unfortunately dragged down performance, it was offset by our inflation hedges such as your Global Natural Resources Fund as well as your Global Financial Fund. So both of which have done really well last year. So the inclusion of both definitely helped to anchor performance. And more recently, we have also included the Principal ASEAN Dynamic Fund. So we view that fund as a more resilient expression for Asian equities. So I'll touch on that a little bit later, but this fund has so far been performing quite well and have been quite resilient over the last couple of months. So moving on to our bond funds. So for our bond funds, the trend was more clear. In 2022, the safer segments, in fact, outperformed the benchmark, while the riskier, higher yielding segment lagged behind the benchmark. So some funds that did really well versus the benchmark were the higher quality, the shorter duration funds like your United SGD Fund, the Lion Global Short Duration Fund, and the BlackRock Fixed Income Global Opportunity Fund. So there was a very clear segregation between the safer segments performance as well as higher yielding segments performance. So moving on to our most recent changes that were made in the fourth quarter. Most recently in December, in fact, we have made several sweeping changes, which I will soon go into details over the next couple of slides. And these changes also reflect our view on the current investment backdrop and how we are positioned to weather the storm. But in brief, we have reduced our fixed income allocation from underweight to neutral, or in other words, we have increased our fixed income allocation along the way, and we have also turned negative on China equities and thereby cutting the overweight position back to neutral. And we have redeployed that into US equities and pushing US equities from an underweight position to a neutral position. All right, so over the next couple of slides, I will go through some of our house view and how we are positioned to tackle this, some of these views along the way. So starting off with the global macro backdrop, and as you can see from this chart right here, last year the global economy went through the largest pace of rate hikes since 2008 in order to rein in inflation, and you can clearly see from this spike right here. So this has in fact resulted in a very sharp global growth slowdown seen over the past 2 quarters. So this is worrying because policy hikes and in fact cuts work with a lag of roughly 6 to 12 months, meaning to say that the negative impact of a hike or a positive impact of a cut doesn't happen until 6 to 12 months later, and they only show up in data 6 to 12 months later. And simply put, what this means is that the impact of the jumbo 75 basis point hikes in the US seen over the last 6 months and also in other parts of the world are only just surfacing in economic data, which we believe will likely worsen over the next 2 to 3 quarters. So take a look at the chart on the right. You can see that the leading ISM manufacturing as well as the new order index, which are denoted by both red line, the red and the pink line, both have turned down and have fallen below 50. So they are right now around the 45 level. So what this means is that the PMIs are in fact dropping and they are in a contractionary territory, meaning to say that the manufacturing sector, which is often the most sensitive sector to the global economic conditions, are in a downturn and are contracting. So you can see from the comparison against US GDP that the ISM manufacturing data often lags GDP growth, often leads GDP growth by around 1 year. And this suggests that economic growth in the US is likely to decline in 2023. So right now, the ISM manufacturing data is suggesting a decline in US GDP growth and perhaps negative growth if economic condition worsens and the PMI falls to a recessionary level of around 40 to 43. So while I'm using I'm using ISM manufacturing index as an indicator here, but if you look across the board, most leading indicators as well as coincident indicators are also showing the same thing and highlighting the same picture of a potential fall in the US economic growth in the months and quarters to come. So we think that is that itself, while this shows the US growth is slowing, in fact, big part of the world's growth is slowing alongside the US. And with the US growth slowing and without China's strong support, like what we've seen in 2016 and 2017, the risk of a global recession is very high and will likely be unavoidable in our view. So moving on to another big talking point, which is inflation and interest rate. We believe that even if a recession comes, inflation may still prove to be more persistent than expected. So there are definitely some serious shortages in the labor market right now, especially in the US. And this issue has been made worse by several headwinds, such as your longer-term demographic changes, like aging population, as well as a broader decline in stuff like immigration. And even though there have been a massive layoff just recently, the labor shortage is still severe, and that the demand for labor has a long way to fall before it matches supply again. So strong wages is likely to keep services inflation high, as a lot of the underlying factors such as your rent, your transport and F&B are driven by disposable income, which in turn is affected by wage growth. And we think that the Fed themselves will likely keep monetary policy tight as long as services inflation remains high. So if you look at the US CPI data in a couple of recent months, you can see that goods inflation have come down, but services still remains relatively elevated. And that in that component, that is driven a lot by stuff like your rent, which again is influenced by strong wages. So overall, looking ahead, we expect inflation to remain more persistent than expected. And at the same time, we expect the Fed funds rate to peak around 5%. So there is still some ways to go before hitting there. And even when we hit 5%, we are expecting Feds to go on pause for the remainder of the year, So the chances of the rate cuts are very slim unless there is a serious steep recession along the way. So all with the implication of this macro backdrop, we believe that we are increasingly finding fixed income more and more attractive. So there are several reasons that underpin our conviction. So firstly, higher policy rates as well as the higher pricing of terminal rates have pushed yields to levels not seen in a long time. So this is captured quite well in the chart on the left. You can see that global bonds, which are often very safe, are now offering attractive yields of close to 4%. Highest in the past decade. So for investors, there is now very little need to invest in riskier products to chase the yields. So that is definitely a fundamental change in how many investors think, and that will also push a lot of demand for fixed income segment, especially the safer segments like your global bonds, as well as stuff such as your Singapore-centric bonds, which I'll show later on. And on top of that, if you look at valuation for bonds, they have also turned much more attractive as compared to equities. And we compare this by looking at the yields of global bonds relative to the earnings yield of global equities. So this is shown by the chart on the right. So you can see that a lower premium, as shown by the declining line on the chart by the right, implies a lower value in holding equities relative to bonds, as investors are receiving less and less potential returns from holding equities, which are riskier. So this tells us that fixed income has become relatively more attractive, and now is a good time to increase exposure. And lastly, with the expectation of a recession this year, safer as well as a higher quality fixed income segment should do really well because of their defensive nature. So one such example is the SG-centric bonds, as well as global bonds. So this is because we expect investors to further rotate away from the riskier bonds to this safer segment. So that will underpin demand for a lot of these safer segments, and therefore, for these three reasons, we are increasingly finding fixed income more attractive, especially the safer segments. So to reflect our views, we have actually de-risked and we have cut our equity allocation while increasing our fixed income allocation. So before we make this change, we were underweight fixed income by about 2.5% and overweight equities by 2.5%. So we can see that in September, in fact. So right now, after making the recent change in December by reducing our equity exposure and increasing our bond exposure, we are now back to our neutral allocation level, which means that we have, on the asset class level, we have no over or underweight. But overall, you can see that since from the table, since August, we have gradually reduced the equities exposure. So in August, we are still 5% overweight equities and 5% underweight bonds. But in December, right now, we have trimmed out all the overweight and underweight, and we are now at a neutral position with no overweight or underweight in both equities or bonds. So looking forward, further increasing our fixed income allocation is definitely something we consider. So further deceleration in the macro backdrop or in earning estimates are some of the major signs that we watch out for before we turn more defensive. So right now, I'm going to talk a little bit about the China's property market, and we believe that the China's property market remains vulnerable. And as shown from the chart by the left, you can see that new home prices continue to decline with no signs of abating, and this in fact shows very little sign of a recovery in the China property market despite recent government support. Again, this is corroborated by the decline in contracted sales of China's top 100 developers in the same period. So this is shown on the chart by the right, as you can see that quite clearly the contracted sales in the same period has also been in a decline with no signs of abating. So overall, the data supports our belief that China's property market is definitely plagued by a larger issue, one that is of a confidence nature. So with home buyers not being convinced that developers have the ability to deliver the properties that have been pre-sold, there is this we think that this 3-decade property bubble is not an issue that can be resolved quickly even with government support. And it will take time for developers to finish their uncompleted projects for which home buyers have already paid, especially if they need to be first restructured. And this will also take some time for a steady stream of completion to restore confidence in the property market. So even if the prospective buyers are confident that a property that they purchase will be completed, they may not feel confident enough about their own financial situation, given the uncertain economic outlook as well as falling home prices. So this may in turn affect the recovery of home sales in the near term. And also as a result of our view on Asian high yield or China high yield as a whole, we have cut our allocations in Asia high yield from an overweight position to a neutral position. And at the same time, we have also bumped up our allocation to SG-centric bonds and global bonds. And I have shared the reasons earlier why we like these two areas. And of course, if you look at our SG-centric bond segment, one good thing is that it also boasts a shorter duration profile, which we expect to be more resilient, as there will likely be a couple of rate hikes left, and we want to protect ourselves from a scenario where the Fed turns more hawkish and catch investors by surprise. Therefore, we have a heavier weight on the shorter duration segment in the fixed income sleeve. So an example will be the Singapore-centric bonds. So moving on to equities, we have recently turned negative on China equities for a couple of reasons. Mainly, we see that structural shifts set off by the recent political changes has negatively altered the long-term investment case. First, from a top-down level, a state-controlled economy may result in a low-growth period, in our belief, as the balance of priorities shifts towards self-sufficiency instead of economic growth. And this is a situation that we see that may play out over the next couple of years. And secondly, a long-term profitability of private companies are also at risk, especially those that are not aligned with the government's policy direction, as we believe that state goals are now more likely to take precedence over profit maximization. And already several key important companies are also seeing increasing stakeholders, increasing amount of stakeholders that have relationship or affiliation with the government agencies, and that also tells us that the government is also trying to have their hand in some of the directions of private companies as well. And the third reason is that we believe China's foreign policies will likely be more assertive, with the presidency potentially steering China away from a reconciliation with the West and increasingly adopting a harder line on Taiwan. So the consequence of this is that that may lead to a dangerous new era of US-China hostility. And overall, that is quite negative on equity markets, or China equities, in fact. And lastly, we see a possibility of a bigger COVID wave after the Chinese New Year, which may in fact impact the China's consumption recovery. And overall, we think that China's growth may in fact disappoint the high expectation placed by consensus. And when that happens, Chinese equities may be repriced lower to reflect this new reality. But most importantly, overall, based on our forecast, we are expecting negative returns over the next couple of years, and a lot of it is driven by the recent rally. So that has reduced long-term upside potential, and also because of several downgrades in our earnings forecast as well as our fair PE. But that said, let us move on to some of the regions that we are positive. So one of the region that we are quite positive on is Japanese equity. So it is our top equity market pick. And if you look at the risk of a recession lately, as this risk gets greater and greater, we are also seeing the unfortunate fact that drivers for equity markets are getting lesser and lesser. But however, Japan is still one of the few markets that is still supported by positive factors if you look around us. And there are 4 reasons why we like Japanese equities. So firstly, we see the reopening as a significant growth catalyst for Japan. So we expect the reopening boost to be full-blown this year, and together with a recovering domestic consumption, that should support economic growth, and we expect Japan's macro outlook to remain more resilient as compared to other developed markets like US and like Europe as well. And the second reason is that Japanese equities or Japanese companies have a strong corporate balance sheet. So if you look at Japanese companies right now, they are in fact cash rich. The cash reserve has improved substantially over the past 10 years. And in fact, if you look at the number of listed companies in Japan, more than 50% are net cash. So this is more than double that of listed companies in the US and in Europe, which are quite impressive statistic when compared against other equity segments of the world. And next is the valuations, which is a big factor for Japanese equities. And valuation for Japanese equities are at a steep discount, almost 20% to its long-term average. So what that means is it is telling us that and potentially entering a recession, Japanese equities are at a very cheap levels, and that may limit the downside of from the initial phase of the recession. Because usually in the recession, in the initial phase, we might see price decline faster than EPS, which might cause a valuation compression. And this is what we are expecting if we are entering a recession. And with low valuations, Japan will see limited risk of this thing happening. And lastly, we expect currency tailwinds from a yen reversal. And with the yen at current depressed level right now, a strengthening, we expect that to be positive for Japanese equities. And overall, based on our forecast, we do expect a upside potential of around 34% by the end of fiscal year 2025 for Japanese equities, which is also a very attractive upside amongst equity markets that we cover. So next, another region that we are positive on and have included in our portfolio is ASEAN equities. And in particular, let me highlight the benefits of the inclusion of ASEAN from a portfolio perspective. So at its core, we find ASEAN to be a more resilient expression of Asian equities. And I will show two supporting data to back this up. So firstly, if you look at if you compare, look at the chart on the left and compare to Asia ex Japan, ASEAN demonstrates half the correlation to China, but almost equal correlation to US and global equities. So simply put, what this means is that investors can substitute ASEAN for Asia ex Japan to cut correlation to China by half while maintaining the correlation to US and global equities. So this can significantly reduce China-related downside risks, which we believe is helpful given our negative outlook for China. And secondly, the Asian equities is more volatile than ASEAN. So in fact, the 12-month rolling volatility for Asia ex Japan equity return, which is shown on the green line on the chart by the right, has almost consistently been higher than that of ASEAN since 2016, which is the purple line. So the higher it is, it means that the volatility of the daily returns is higher. And in fact, this difference in volatility between ASEAN and Asia ex Japan has been widening due to China, because Chinese equities have been getting more and more volatile over the past couple of years, especially the last 3 years. And you can see that quite clearly from the surging black line on the chart by the right. So simply put, the Asian equities right now is almost twice as volatile as ASEAN equities at this point in time. So with ASEAN being low volatility, as well as having lesser correlation to China and more immune to China-related downside risks, we see ASEAN as a resilient expression for Asian equity exposure, and therefore we are glad to include that in our portfolio in the tactical allocation segment. So in terms of equity allocation, we have recently cut our China exposure from overweight to neutral, and we have reallocated that to US equities, which is an area that we are growing more keen, because we see fading headwinds for US equities with the potential end of rate hikes in sight and with falling real rates. So after falling about 18% last year, a lot of the damage, as we believe, has also been priced into US equities. As if you compare that with the median drawdown in a recession, the median drawdown in a US recession is about 25%. So having fallen 18% last year, definitely a lot of damage has already been priced in. But that is not to say that it will not fall more than 25%. And that remains a possible case if the recession turns out to be much more severe than what many expected. And Asia and Japan is also another region we have our eyes on, but for the opposite reasons. So given our change in view on China, as well as several Asian markets like India, Hong Kong, and Korea, we have also dialed back our positivity on Asian equities. However, we opted to retain our allocation to Asia after cutting China's exposure, because by not extensively cutting Asia's allocation, we can still ensure that the portfolio may still benefit from any China or Asia-related rallies. But overall, within equity markets, we remain positive on Japanese equities and maintain our overweight position moving ahead. And in terms of underweight, we still remain cautious on Europe as well as digital economy stocks. And so those are areas where digital economy stocks is an area concentrated with growth-oriented stocks. And that is an area that we are likely to remain cautious on moving ahead. So with that, I conclude today's presentation, but I'll be glad to take on any questions. So feel free to leave them in the chat and let me look through some of these questions before answering back. So there is a question on China's reopening, and do I think that the recent rally still have some room to go? Okay, so our views on the China reopening, yes, for China's economy and for China's growth, the reopening is definitely the right way to grow. And for China's growth this year, for the year 2023, China's reopening will definitely be supportive. But in terms of the recent rally, we think that the recent rally has happened quite fast indeed and quite hard. So very fast and very hard, and a lot of positivity has in fact been priced in to China's reopening. But as we all know, with every reopening, from Japan's case, from Europe, from the US, in fact, the playbook has been the same. So when a country reopens, the cases will spike. So once that happens, then the true test will come when policymakers decide if they will have to make any adjustment to this reopening policy. And I think investors are starting to watch for that. If there is some backtrack, or if there is some spillover or some damages to the economy because of this reopening and high COVID case count, then investors will price in that negativity, and we will see that we see it as in the markets, we see that as the rally retreating and perhaps repricing lower to account for this negativity. So in short, will the rally have room to go? It will have room to go if the reopening goes successfully. But if you look across the playbook for US, Europe, and Japan, very rarely does it go quite successfully. And with a quite conservative approach for the Chinese government, chances are that a lot of optimism has been priced into Chinese equities. And I think this is a rally that we still have to be cautious about moving ahead. All right, and I see another question on US dollar strength. So maybe I'll tackle that quickly. So mainly the question asks, will the US dollar strengthen moving forward due to high interest rate environment? So in brief, our house view is that the USD will likely peak and will correct itself this year. So while interest rate stays high, what we are seeing is that a lot of the other markets, because US has high rates first and quite ahead of many of other markets, so rates have hit a high quite fast for US markets. But many of the other markets, such as Europe, and in fact many of the European nations, and as well as the Asian economies, are catching up and are hiking rates at a point where US is talking about a pause. So what that means is that the difference in interest rate will narrow. So we call that the interest rate differential. So that is likely to narrow this year as the Fed hits a pause and the hike looks increasingly unlikely, while some of the other central banks are catching up and hiking at the same time. So the difference in interest rates will narrow, and that will be less supportive for USD strength, because a widening interest rate differential was the key driver of the US dollar last year. So in fact, this key driver will now be in reverse, and therefore not so supportive of US dollar strength this year. And another reason that supports US dollar strength that goes hand in hand with the interest rate differential is the fact that USD is usually seen as a safe haven currency, especially if the US growth is outperforming the rest of the world's growth. So that itself supports a US dollar safe haven narrative. So what we are expecting this year is that the USD might not be as good of a safe haven destination this year, because firstly, the interest rate is likely to peak this year, and the interest rate differential will narrow. So there's less supportive reasons to be in US dollar, and investors can find or carry for carry trades. They can find higher yields in other currencies, and especially currencies like Brazil, the Brazilian real, or the of some of the other Latin America currencies where the interest rates are much higher. So that in fact supports USD. That will be less supportive of USD as a safe haven currency, and at the same time, US growth this year will likely slow, as I've shared in my presentation. While the rest of the world growth will slow alongside, but in the US we expect a much bigger slowdown, much bigger slowdown in the first initial period. So overall, we are expecting the US dollar to be less of a safe haven currency, or less attractive of a safe haven currency. Whereas if you look at other countries like Japan, for example, the yen, well, yen has lost a lot last year, but this year it will be seen as a much better safe haven currency, especially with the recent appreciation and the expectation that yen is likely to appreciate this year. So US dollar, the safe haven flow that went to USD last year will redirect to some of the other safe haven currencies like the Swiss franc or the Japanese yen, and therefore that will likely to weaken the US dollar even further. And therefore, this year we're expecting the USD to roll off its peak and to correct itself. All right. Maybe I'll answer the question on the preference for short-term bonds to long-term bonds. Right now, the reason why we have preferred short-term bonds for quite a while last year and this year, entering this year as well, is because of its short duration exposure. And simply put, if the bonds have high duration exposure, it is much more exposed to, it has much higher interest rate risk. So what this means is that whenever interest rate goes up, prices of bonds would like to fall more for bonds that have high duration exposure. So these are typically your long-term bonds. So with the expectation that Fed will still hike rates, despite it being a 25 basis point or 50 basis point, they will still hike rates until the terminal rate of around 5 to 5.2%. And therefore, short-term bonds or bonds that have lesser duration exposure are likely to be less resilient and see the likelihood of having less decline in prices as compared to long-term bonds. And this is a reason why we prefer short-term bonds now, and we have preferred short-term bonds over the past couple of months. Okay, let me answer the next question. Will the yen head south? Right, so last year was a bad year for the yen. Yen dropped about, I think, 20-30% against the US dollar. But this year, we expect, our view is that the yen is likely to appreciate or strengthen against broad currencies. So there are a couple of reasons why. So like I mentioned earlier, firstly, I think the attractiveness of the yen as a safe haven will increase this year, definitely. And that is in part due to a less attractive US dollar as a safe haven. So investors will look for a better safe haven, which is the yen. And a big reason that supporting the yen attractiveness as a safe haven is the fact that Japan will likely perform better. The Japan's economy will likely perform better as compared to the US and Europe. And having that relative economic strength lends confidence to the investors to move to find a better safe haven destination. And then secondly, we expect the BOJ to tighten this year. So by tightening, we are not expecting a significant hike in rates. For example, we are only expecting the target bands of the yield curve control policy to widen, especially for the 10-year period. So that will cause yields to go up in Japan. So Japanese government bond yields will likely go up this year, and that will be positive for the yen. And at the same time, the interest rate differential between yen and the other currencies will narrow with the JGB yields going higher. So that will be supportive for the yen as well. And all these factors are telling us that the yen will likely appreciate this year. However, the pace of the appreciation might not be very wild because of the backdrop, but still the direction is north for this question. All right, let me look at some of the other questions. So, okay, why is the US 2-year bond yield higher than the 10-year bond yield? So is it because of higher interest rate or the uncertain economic outlook? All right, that's a good question. So simply put, the 10-year treasury yield is in fact affected in part by policy rates and in part by the market's expectation of the economic outlook in the future. So as compared to US 2-year bond yield, which is mostly affected by policy rates and less by the market's expectation. So the difference in the yields in the 2-year as well as the 10-year is telling us that the market is expecting an uncertain economic outlook, a poor economic outlook, and for economic growth to deteriorate in the future. And that and in that outcome, inflation expectation will fall. And as a result of that, the market expectation portion of the 10-year treasury yield has declined substantially. And because of that, the 10-year bond yield right now is lower than the 2-year bond yield. And so to simply put, to answer that question, is it because of high interest rate or the uncertain economic outlook? I would say it is because of the uncertain economic outlook and the expectation that economic growth in the future is going to be deteriorating, and growth is unlikely to be as good as what we've seen before. All right, so the next question with what industries or sectors we should invest in or avoid in 2023. So right now, entering a recession, we are positive on several sectors. So a sector that we are positive on right now is consumer staples. I think consumer staples is a tried and tested, proven recession-proof sector, because if you look at the consumer staples right now, there are a lot of positivity going on for them. Firstly, if you look at across history, during a recession, EPS for consumer staple stocks declined the least. Prices also declined the least from peak to trough. So that already shows from historical perspective, prices as well as EPS are more resilient for consumer staple stocks. Secondly, what we are seeing right now is this trend called trade-off in the consumer staples sector. So there are a lot of consumers, especially the richer consumers, are now substituting the expensive goods for cheaper goods, and goods that are of more value. So goods that are not only cheaper, but they are of more value. So that is driving a lot of sales away from consumer discretionary items such as your cars, your expensive bags, and your expensive phones, and into consumer staple goods such as your snacks, your canned food, your soups. So all that is driving sales for consumer staples, while some may argue that inflation is definitely eroding the margins for many of these consumer staples company. But we have been seeing that happen most of last year, and we are seeing perhaps a bottoming out of the decline in profit margins as the inflation in the US and in the rest of the world peaks. Costs should come down, and at the same time, many of these consumer staples companies, they have pricing power. So with strong pricing power, or with a resilient pricing power, as well as declining costs, we're expecting margins to bottom out this year, and that could in fact be a positive turn for consumer staples sector. So overall, consumer staples is one area that we like, and a couple of areas that we like, maybe to extend beyond sectors, like I mentioned earlier, some of the regions is also ASEAN region. And another sector that we like is also healthcare, as well as the commodities related sector. Commodities related sector should do well this year, because firstly, if you look at the long term, we see structural support in terms of supply. There is definitely a supply shortage that will last beyond the near term. And if you look at the demand, yes, demand is expected to be hit by the recession. But at the same time, we have counter forces coming from China's reopening and perhaps a milder recession might mean that the decline in demand might be shorter. So overall, beyond the near term, the demand supply dynamics are definitely favorable for the consumer staples, for the commodities related sector. So that is also another sector that we like. So in terms of sector to be avoided, for now, many of these growth sectors, we still we are still not too positive on many of these growth sectors, such as the non-profitable tech companies and non-profitable internet companies. And I emphasize non-profitable because in a growth space, there is definitely an area where you have high quality companies, mostly are the big tech companies, and you have the other one, which are the expectation of high growth companies, but they are not so profitable. So those are the companies that we advise to avoid, and in fact focus on the high quality companies that high quality growth companies that should do well in a recession. So in terms of which sector to avoid, definitely the non-profitable, the high growth and non-profitable areas in the growth sectors. Okay, let me move on to the next question. So I see a question asking on infrastructure. For us, we have no official coverage on infrastructure, but personally, I think a lot infrastructure is a sector or an industry that is cyclically driven, meaning to say that when economic growth goes higher, the sector booms, and economic growth slows, the sector contracts. And a big part of it is because economic activity will generate the need to build more infrastructures, be it a government's mandate or be it a private sector's mandate. So infrastructure itself is a highly cyclical sector. So with the fact that global growth is slowing down and is expected to slow down even further, the outlook for infrastructure, it definitely seems more challenging, especially in the near term. Even though there is definitely the possibility that the government might enact fiscal policies to drive infrastructure spending, but we think that the room for this is quite limited, again, because we have just been through COVID and there has been a lot of government spending across the world, and the fiscal accounts for many governments around the world are not as healthy as, say, before COVID or entering COVID. So the prospects of fiscal stimulus that is infrastructure focus is now lesser than what it is back then, and therefore the tailwinds for infrastructure, at least in the short term, is not as promising. And overall, we're being weighed down by a potential recession. I think the near-term outlook for infrastructure is definitely more challenging. Right. So I will take a last question. Let me see. Okay, I see these questions asking about our allocation. So why are we still allocating about 19 to 22% of our US of our equity investment, respectively, to Europe and US, when valuations are still high and has a long way to fall, and Europe has so many macro problems? Okay, so to answer this, let me first say that our MAPS portfolio allocation is based on a GDP weighted approach. So in essence, we weighed out the GDP of the key regions that is under our allocation, such as US, Europe, China, and even with the inclusion of digital economy stocks, we try to quantify that. So our allocation is based on the GDP weighted approach. Whereas if you look at global equity portfolios or just global equity and bonds portfolio, many of them are weighted based on market cap. So what this means is that the allocation to Europe and US, for that matter, is much higher for this portfolio. So for portfolios that are based on market-weighted approach. So comparing both portfolios, so our portfolios, which is GDP-weighted, and global equity and bonds portfolio that is market cap-weighted, we will find that our allocation to Europe and US is in fact much lesser than a global equities global bonds portfolio. So I'll give you an example. So if you look at an MSCI AC World Index, for example, that is market cap weighted. So I believe around 60% are at least US equity exposure. So that is in fact much more than our allocation to to the US, and for Europe, ours is also much lesser than a portfolio that is market cap weighted. So overall, we believe that compared to those portfolio which are our benchmark, we have a considerably lesser allocation to these two areas. However, if you look at our own allocation relative to our neutral weight for US, yes, we do have a higher exposure. That is because we have a slightly more positive, a little bit more positive view on the US, and it's despite valuations falling, is valuation still high? I think valuations right now, valuations right now is generally still high as compared to what we've seen over the last, say, 4 or 5 years. But if you take a longer horizon, valuations right now are looking much more palatable as compared to a longer term historical average. While we think that valuations is still under pressure because of high interest rate, but as we go along, I think the valuations are definitely much more attractive as compared to what we've seen over the past couple of years. And as this valuation gradually moves lower, we are more inclined to add more as it goes along, as we try to avoid a situation where we see a huge valuation contraction and we try to add it all at the same time, only for it to reverse. So this is something that we want to try to avoid as well. But in essence, our allocation to the US is definitely lesser than what we will be allocating if we are market weighted approach. And for Europe itself, we have underweighted Europe, and that is also in response to our view that Europe is facing some macro issues and is facing some structural issues as well. So I think we have actively tried to underweight Europe, but at the same time, if compare our weight for Europe against a market cap weighted approach, we are definitely having a lesser weight to that. So overall, I would say that yes, it might seem like a lot by itself, 19 to 22%, but in fact, as compared to our benchmark, we have a much lower weight, and compared to our neutral weight itself, Europe is much lesser, while US is higher because we are expecting we have a more positive view on US equities. And hope that answers the question. And with that, I conclude this sharing today. But if you have any questions, feel free to send them in, and we try to answer them to our best of our abilities. All right. So with that, I'll pass the time back to Ikai, our host.
Thank you, Colin. Thank you so much for the wonderful sharing. And also thank you to everyone here who is with us this evening. I hope that you find the sharing useful in your investment journey. So for regards to questions, feel free to send them in, and then we will answer them to the best we can. So right now, you can also contact us after the webinar through the email that was sent out when you guys register for the webinar itself. So lastly, before I end today's webinar, I would like to share that the next webinar will be in 2 weeks' time. This time around, there was a question about short duration bonds versus long-term bonds, and then so the next webinar will be about the bonds itself. So keep a lookout for it, and then we will be promoting in due time. So with that, the webinar has ended, and have a great evening, everybody.